Exchange-traded fund volumes have begun to account for as much as 50% of all trading volumes on foreign exchanges, with many investors choosing only to invest in these passive strategies. Choppy markets and the mediocre performance of active managers have made the decision increasingly easier. Here to discuss the performance of fund managers and their role in an investor's portfolio is David O'Leary from Morningstar. David, thank you for joining us from Cape Town. But I just wanted to begin with a quotation that you put in a recent article that you wrote. I couldn't resist it. There are three kinds of lies: lies, damned lies, and statistics. And now, of course, we know that is the quotation coming from Benjamin Disraeli. And really, when you look at it, surely shouldn't we just be worried about performance and not worry about anything else?
Yeah. The short answer to that, I think, is no. I think there's a lot more to think about than just performance at the fund level. From an investor standpoint, there's a lot of other decisions that go into number one, reaching your financial goals, and then just making it a comfortable enough ride along the way. So, for instance, how much volatility an investor experiences along the way, and whether they can sleep at night is an important consideration. That doesn't just get captured in pure performance numbers.
Yeah. If I were to pigeonhole you, would you say then that you won't give me a straight answer if I asked you the question, active versus passive? Is that yes or no?
Yeah, I think you've probably accurately pinned me. Yeah, I mean, for me, I choose the best option.
You're hedging your answer, David.
David, just to come in here, Warren here, I just wanted to ask you, we have this debate that's been going on. Obviously, our ETF market is still fairly new. We've only been going about 11 years with exchange-traded funds. And most investors are still getting their heads around what a passive strategy is and where it fits in a portfolio. We just wanted to ask, when we look overseas, we see that there are many, in fact, so many people now that are moving across to exchange-traded funds on the basis that they're just an easier way to invest. What's the case for the active fund managers overseas? And then if we could ask you your opinion on how they're doing in South Africa at the moment.
Sure. I think the case for active management is, we've seen it illustrated numerous times. So when we look at ETFs, I think we have to separate the traditional sort of passive strategies associated with the original ETFs when they were first launched. That's all that existed. But now more and more there are quite exotic types of ETFs, including actively managed ETFs. Let's exclude all of those and just focus on the passive ETFs. I think we've seen numerous cases where the dangers of passive investment have been illustrated. So I'm coming from Canada, for instance, where, and I think there's a lot of similarities with the South African market. It's a very concentrated market with where resources and materials sort of dominate the economy. Financials is another huge part of it. And single industries, and even in some cases in Canada, single companies can make up a huge percentage of the index. And so a passive strategy would continue to buy shares in that company or that industry regardless of what percentage it makes up of the total portfolio. And that can have disastrous effects for the investor if that industry or company collapses. In Canada, that was technology. Companies like Research in Motion, which makes the BlackBerry, made up 30% of the broad market index, so our equivalent of the FTSE JSE All Share. And it collapsed in 2000, 2001, and investors were really punished for that. So I think active management makes a strong case on the risk management side. And then the other thing is the overall numbers. I mean, if you exclude what I call or what a lot of people term closet index funds, actively managed funds, the number of them that outperform isn't all that bad. Numbers that I've seen start to look at it looks like more like 50 or 60% of them outperform their benchmarks in the markets that I've sort of looked at. But that's not I haven't done a robust study across the world. But
David, sorry,
the numbers
just to
look a lot better if you exclude closet indexers.
Just to come in here, I just wanted to ask you, with respect to different market conditions, your experience both in Canada and obviously from what you've seen in South Africa, is it easier for active managers to beat the index in markets like these, say since post the global financial crisis, or generally do active fund managers do better in bullish markets where the overall trend is upwards?
I mean, I think from a cynical standpoint, it's definitely in bear markets where, at the very least, even if you had an incompetent manager who held some cash in the portfolio, that cash drag helps in a bear market and hurts in a raging bull market. And if you have a skillful manager, ideally they'll provide some downside protection. So I would think on the whole they typically do a better job on the downside, but there are exceptions to every rule.
We have a core of very strong active fund managers in South Africa that continue to outperform the index despite the tremendous amount of assets that they gather as they become successful. I just wanted to ask you, from your opinion, what are some of the key things that you look for in a manager that's going to be able to continually and consistently outperform an index?
Well, at Morningstar we look at 5 broad factors. We call them 5 pillars. They all start with P. So the people, who are the individuals running the fund, what's their past experience, what are their accreditations, the parent firm that's offering it, and the stewardship or governance of that firm. Are they really interested, or do they take care of their mutual or unit trust investors? So what are fees like, things like that. We look at the outright fees of the fund. That's probably the biggest determinant of whether a fund will outperform or not on a long-term basis. We look at the process that they use for investing and their long-term performance, obviously. So, I mean, each of those factors can be a different sort of weighting depending on the exact situation. But I would say if I had to pick one thing, it would be a manager with a real consistent process that makes sense and that they apply consistently. A lot of managers, it's easier said than done. When it's working well in their favor, they're able to stick to it. But then when things go wrong for a little while, some poor managers will switch from their strategy and start to just buy whatever's hot, and that hurts them in the long run.
Yeah. Now, David, I don't know whether you've had a chance to look at the South African market and find out what the stats say in terms of active managers that actually outperform their benchmarks. I mean, globally, you have written that the majority of fund managers actually fail to outperform their benchmarks. In South Africa, is the picture the same?
Just to clarify, and I haven't looked at it globally. In Canada, when I did this, when I did analysis on this issue, if you exclude those closet index funds, those ones that are not really actively managed but are charging fees as if they are, if you exclude those funds from the list, you start to look at 60 to 70% of the funds outperforming. Actively managed funds are outperforming. I haven't done the numbers for South Africa, so it's a good question. My initial impression is that there are a lot of good money managers here from the ones that I've met, but I haven't certainly done an exhaustive analysis yet.
David, just you've recently, or not recently, you've recently announced the Morningstar fund manager winners in South Africa. Could you just tell us a little bit around the process that you undertook to identify these managers, and hopefully we will attach it to one of our feeds for our viewers so that they can go and look at these fund managers and perhaps have the confidence that they're picking someone that's been vetted and been evaluated based on performance and these factors that you've been talking about.
Yeah, so just a bit about the awards are we do globally, so in probably somewhere in the neighborhood of 20 plus countries. So South Africa is one of them. It starts with, the process for selecting the winner starts with a quantitative screening process. So we look at, it's an annual awards, so we want to, we factor in more recent performance more heavily than we otherwise might, because every year we announce new winners. But we start with what are funds that have proven themselves over the long term. So what we don't want to do is just award funds that are hot this year, but collapse the next year, or vice versa. So we start our list with what are funds that have done a good job over the long term, and so we start with looking at 3 and 5 years. It would be ideal if we could look at longer periods of time, but you start to look at your eligible universe of funds starts to narrow dramatically if you start to limit your criteria to a fund must have a 10-year performance track record. So we focus on 5 years or 3 years if necessary. And we don't just look at outright performance, but risk-adjusted performance. So, all else equal, if two funds have the same return, we're going to prefer the fund that took less risk in order to achieve that return.
Right. David,
and then from there we will screen
David,
out
unfortunately, we have run out of time. David O'Leary is Director of Fund Research at Morningstar. And if there are any football fans watching, I did ask him if he was related to the great Aston Villa manager David O'Leary as well. And he did say no, he wasn't.